Hey guys, this is Randy Finney with Right Side of the Chart, and today is Friday, April 13th, 2018. This will be a very quick update, probably one of the shortest videos. I just wanted to share some comments that I made in the trading room. This morning before the market opened, we had the futures up, indicated that we'd gap up, which we did, and there was a comment from one of the members, thanking me for pointing out these bearish rising wedges on the 15-minute time frame, intraday time frames here. But I sent a reply, and again, these are just my thoughts. But my take was, and we gapped up and we were at the top of the wedges at the time, that I suspected these wedges would break down, and that they'd probably break down today. No later than Monday. So they have broken down now. And the reason I said that was twofold. Number one was the fact that these are so obvious that anybody using TA, following anything, trading actively, is watching these wedges. There's negative divergences, everything you like to see, everything I normally like to see. However, well, that was reason one that they'd break down, only because the pattern was so clear. You're going to get traders that jump on it, short inside the wedge, short the breakdowns. And the other thing is what the nature of a rising wedge is, it's contracting. So the point that we were at, getting near the apex is where these two lines would cross, but this is a sweet spot, about 70% or so, give or take, towards the apex of the wedge. That's where rising wedge patterns usually break down. So because we only had to go down a little bit to break down, we were so close to that trend line, we had the divergences, and it was such an obvious pattern. My expectations would break down. However, I believe it will be a false breakdown. Um, and as I often say, fewer things are more powerful. What this does is two things. It shakes out any weak-handed longs here, and it also sucks in shorts. We've already broken down. You can see the candle there. And whether we go down a little more or not, my guess is that this wedge does not play out to its measured target. Again, this is just my read on the charts. My reasoning for that was some of the longer term, more significant bullish developments on the longer term daily time frame that I just covered in recent videos. There's a gap right there. We're at the top of the gap now. Maybe we go down to the bottom of the gap to backfill it, and that would be about it, I think. And that would be, the just if you're not familiar with rising wedges, the simplest and I believe most effective tool, because I've done this over the years and it's amazing how well this plays out. You just take the widest part of the wedge, which I've done here, add it to where the wedge breaks down. That gives you your measured target. There's all kinds of formulas online. You can pull out your calculator and use them. I find this quick and easy. And then usually if I was trading, if I believed in this wedge, I would then, in this case, with a measured target there, I would target the closer support level. That's how I would do it. I have a support level here and a support level there. That would be my target if I was a believer in this breakdown. Unfortunately, well, it doesn't matter. Unfortunately for me, if it proves out to be wrong, but I'm actually going to add some long exposure here on the breakdown because I believe it'll be a false breakdown, whipsaw signal, and fewer things in trading are more bearish than a failed breakdown because of the reasons I mentioned. You get a new subset of buyers or set of buyers in the stock. Weak-handed longs have been up this, taken this rally, or maybe just bought, have been shaken out, puts in a more, stronger core base of holders that are still long and willing to weather out ups and downs. And more importantly, you suck in some shorts. Undoubtedly, there's some shorts that either shorted the top of the wedge or the breakdown in anticipation, and they will then, if they're, prudent trading, at one point they'll be squeezed out if we reverse. If I'm right, now guys, I can be wrong, but so if we reverse, we go back in the wedge. That's number one for them. Why are we back in the wedge? Maybe a back test, that's one thing, but when you get back inside a wedge, that's your trend line. That means you have a failed breakdown at that point. And if they don't cover there, you can see right here, I can put a line. We had a lot of reactions here, 162.65. They really ought to cover there, in my opinion, if they haven't. Otherwise, we can go up. So again, maybe a little more downside. Maybe I'm wrong. Maybe we go a lot lower. But anything, either way, whether you want to short this, that was my reply in the trading room. Is it objective? Sure. I sometimes read between the lines. I'm not a rigid trader with set rules where I'll short every trendline break, rising wedges, negative divergence. Normally I would, but in this case, like I said, I'm going off instinct and experience and looking at other factors in the market that tell me we're probably going to continue to go up. So I view a breakdown here as actually a buying op, and I know that's contrary to technical analysis, you short a breakdown of a bearish rising wedge pattern, you don't go long. But so we'll see what happens. And again, if I'm wrong, as we go down here and slice through these levels, like I said, the bottom of that gap right here, 160.64, that's my I want to say my lowermost target. I can even put there's some support there. Let's just say this one here, about 160.24. We start to go below 160.24, 20-ish, then I'll start to be concerned. I'll stop out of what I've taken or scale out. I have positions, that are profitable from back here, swing trade positions on the long side. But what I take today as a day trade op or adding exposure, that's where I'll become concerned if we go much below that. And if we do whip back in here, again, we have a false breakdown, so we're probably going higher. And for you SPY and ES traders, and you can these trend lines will be similar on the ES charts. I'm just covering the index ETFs. There it is. There's the breakdown, impulsive reversal off the top of the wedge. Again, these are beautiful textbook bearish rising wedges. I can understand why most might short, and I can understand why I may be wrong, but I don't believe I am at this point. That's why I'm doing this video. I think it's important enough to note that. You can see so far we've caught support right there on that. I've had that line there for a while, 265.14. You can see the reactions here. You can see gap back here. You can see a reaction high. So a lot of pretty technically significant support level. And if we break that, this would be my downside, comparable to that where we'll probably start to be proven wrong on this if we go down here and we go much below this 263.36 support level. You can see it's pretty well defined. A lot of reactions from above right here, reaction from below back here, reaction from below here, and a reaction from below there, as well as reactions from above right here. So I think it's a significant level. And if we go much below that, then this wedge is playing out, and then those that shorted it did the right thing. So here's the widest part of the wedge. Here's a measured target down here, and I have a support level right around that line. I'll give you the number if you're short and you're going to try to looking for a target to cover on. 261.35 would be the target. But again, I'm looking for a reversal anywhere from this level down to this level and a move higher. And if so, we could get some pretty impulsive buying once we get up and take out today's high, because that will, so far, and another thing that adds fuel to the bear's belly, or, fire to their belly right now and gets them amped up, is this false breakout here, this 266.90 level I talked about on the SPY. A lot of reactions. This was comparable to that, resistance level that QQQ was punching against. We've had several attempts to get out of there and then a failed breakout. So, you can look at this glass half empty, half full. There's certainly a case to be made for a short. I'm just, going off experience and instinct, and I'm not chasing this one on the short side. I'm going the other way on it. All right, guys, hopefully this helps. And again, whether I'm right or wrong, whether you're long or short, that's what stops are for. If you shorted the breakdown, set your stops somewhere back above the trend line, maybe allow for a back test, certainly above this 266.90, or at the very least above that recent reaction high. Because if we go back up there, the pattern is clearly foiled. It was clearly a false breakdown. And if you're long, you want to start become concerned if we get up under 263.36, especially on a 15 or 60 minute closing candlestick. It's not uncommon in this market to run below support levels and then reverse quickly and print a candlestick close back above there. That just washes out. It's called a stop run. There's a lot of stops placed right here, I imagine, for longs under that level, as there are under here. All these support levels. That's how technical analysis works. And those with the money, then the big trading firms, high frequency trading, algo trading programs, they know where the stop clusters are, and they'll run them more often than not. So that's why I don't set my stop at 263.35, for example. It'd be a little bit above there, and I'll watch the action, and also usually give it at least a 15-minute candle. Hopefully this helps, guys. And if it doesn't, if we start to move lower, impulsively take out those levels, I'll do my best to update my outlook and communicate my thoughts as to where we might be going if and when that happens. But as of now, I'm still looking in the coming days to weeks. It's Friday, so I'm looking next week. More upside in the market to any of these targets. I already shared the price targets in previous videos, so I'm going to cut this one short, just shy of the 10-minute mark. Hope you have a great trading day.